Hey Zeta Army, we hope you enjoyed our last video explaining options basics. With that in mind, we're stoked to get into what everyone is really after, how to earn huge yields with options and get paid to buy the dip. Let's get into it. Options can be used to earn a lot of yield while still keeping your capital safe. Selling options can be an attractive way to collect premiums so you can bet big on another day. Let's take a quick review on what options premiums are. Options premiums are paid from buyer to seller in order to compensate them for the payoff of an option. Sellers can take advantage of these premiums to generate a huge amount of yield while still managing risk effectively. Let's walk through a really simple yield-generating strategy, the cash-secured put. Zeta Trader and HODL Trader both have $5,000, and the price of Solana is $200. And let's say the 1 month out $100 put is trading at $5. HODL Trader thinks that Solana is a bit expensive right now after its last rally on up, and they want to wait to buy the dip. They choose to do nothing with their $5,000 and wait for Solana to drop to $100 before entering their position. But what if there was another strategy? Zeta Trader could also sell the 1 month $100 put 50 times, as they have $5,000 worth of collateral to secure the put and earn yield while still buying the dip. Let's explain this in more detail. If the price of SOL moves higher within that month, HODL Trader is still left holding $5,000 and praying for a dip. Zeta Trader, however, has earned $5 times 50 puts, or $250. That's a 5% yield or 80% APR. Pretty awesome if you ask me. On the other hand, if the price of SOL moves lower within that month to $100, HODL Trader will deploy their funds and buy the dip at their entry price, $100, buying 50 SOL and spending $5,000. Let's say that Zeta Trader has sold the $100 put, which means that they are now obligated to buy SOL at $100. They also buy the dip at their entry price, spending $5,000 for 50 SOL. You see, Zeta Trader still keeps the premium they have earned on the puts and has $250 more to buy the dip with. If we review what has happened, Zeta Trader and HODL Trader have both bought the dip, but one person has earned yield whilst the other hasn't. Zeta Trader was able to take advantage of the cash-secured put in order to fully reap this reward. In summary, what's happened here is called the cash-secured put strategy. Zeta Trader has picked a strike that they want to buy the dip at and put aside enough cash to buy SOL at that strike price. The math looks like this: 50 puts times 100 strike equaling $5,000. Because they sold the put, they're also able to earn the premium associated with it and pocket that 5% yield. Of course, every strategy has its risks. If Solana dips to $50, Zeta Trader still has to buy it at $100, whereas HODL Trader can keep waiting and try to time the bottom. Zeta Trader is also locked in this position at the start of the month. Once they have sold that put, it may be hard to buy it back or close out the position, meaning they don't get a choice of changing their mind once the market starts dropping. On that note, every strategy has a time and place, and we're stoked to be able to share them with the Zeta Markets community so you guys can be the smartest traders possible and earn the biggest yields you deserve. Thank you for tuning in into this week's video. Don't forget to leave us a thumbs up if you liked it. Stay connected with the community by joining our Discord and following us on Twitter and Instagram. Everything is linked in the video description down below. My name is Maz, signing off until next time.